Don't just tell me 1, 1.2, tell me 1.234.
There wasn't that much of those. I wouldn't stress that. I'm at the point where as long as I graduate.
You put in your answers, and you just pass the test. 1.234, 0.567. Don't just tell me 0.72. No. So I need to send you a list of all the stocks.
Realistically, I just need like
all the stocks, all the data. Don't send me a spreadsheet. Write it in text form.
Well, you also get it.
And you have to email it. An email, not a document, an email.
So like even if you like I don't know, I've never really heard of anyone like
I'm sorry, January 31st.
They usually I think curve it to be like theoretically
You're talking about case study 1, it's like case study 1. That the data will be slightly different in Ubers and the Yahoo Finance data. Use the Yahoo Finance data. They'll be closely
yeah,
the beta was 1.2.
Yeah, that's great. Yes,
And the Uber is 1.24. And you probably got the right answer.
Yeah, I like it better. Honestly, when I was in Australia, I like their I was there from December 27th to June 2nd. Yeah, so like 5,000 per period. It was awesome. I was in Sydney at the University of Sydney. I was in like the central. I was living in like the CBD, the central business district there. Awesome back-to-back summer. Just gotta skip the American business eventually, but the only one of my really close friends there is actually like I went there with a close high school buddy, and then we made a few buddies here at Washington, a few at Indiana, a few at Indiana. Actually, I'm from Chicago, Vienna is like like I feel like they're all sponsored by I got like all this time. I do, but they the same time, it's just like I think it's literally the same. The emissions is like I think the main difference is just like the breeding. Well, I'll show you a classic Chicago hot dog. It's got like mustard and relish on it. This is like an ideal hot dog.
All right. Here we go.
I think
So last time we talked about how to value a stock. This time we're looking at a stock to value it.
I don't know. I thought it was like
I went to S&P Capital IQ. For some reason, I'm not able to log into S&P Capital IQ. My account right now. So when I do a pre-recorded video, when I record a video, probably this weekend, I'll have to do the slider with the timeline to show you how to get the right set of data. But I went and got data going back to 2015 for this particular stock. It's Visa. What Visa? You mean like the Visa card in my pocket? Yes, it's that Visa. Yeah. Let me tell you what you need to know about Visa, the company. They don't issue credit cards. This bank does, that bank does, that bank does. They don't issue debit cards either. This bank does, that bank does, this bank does. Or the other financial organizations do. What Visa does is it has A combination of hardware software system. It's got a little box, so when you go to the grocery store or the restaurant or something there, you swipe it or you tap it or you let it sit there for a while until it goes, yeah, I got it. So that's a piece of hardware. And it's electronic system, that's a piece of hardware. And it's got software that says, and that 16-digit is on your card. Yeah, that's not recorded to be stolen, and yeah, credit limit's okay. Pay for the groceries, pay for the meal, something like that. Okay. That's what Visa does. It operates / owns that hardware / software system, and when you swipe it, click it, they get something like 1/10 of 1% of the amount that you put on the card. Something like that. A pretty small amount, but you know, when people go like this, and it's like this every single day throughout the year, it adds up. If I had to think of one stock that in some sense was representative of the entire US economy, one stock, maybe I might be tempted to pick a conglomerate, something like Berkshire Hathaway. It has more than its fair share of insurance though. I'd be awfully tempted to pick Visa though. Granted, it's not quite the entire US economy because what I just described is a fraction of the entire US consumer economy. Right, because as a consumer, you go to the store, and it's roughly true. You pull out your wallet, you either take your Visa, your MasterCard, or you pay cash. It's a slice of the economy. It's more complicated than that, yeah, because sometimes you go online to Amazon, and there you don't pay cash. You use your Visa or your MasterCard. And a few people use American Express, and yes, I have to. So just after class, take one there. And there's also not just the consumer economy, but what do you want to call it? The industrial economy, the producer economy, the producer side of things. But sometimes producers pay for stuff using Visa as well, too. So, but also Visa is used outside the U.S., so it's not strictly speaking the U.S. economy. Well, hey, nothing's going to be perfectly representative of the U.S. economy in a single stock, but Visa might be as close as it gets. Yeah? That's an observation that's worth making that I might use later on. That's my description of Visa. I'm giving you the bare minimum that I think you need to understand my analysis. I got data from Capital IQ. I downloaded the entire financial data that they would give me. And then this is what I did. I know it's too small to see, but I'll try to fix that in a moment. The key stats, the income statement, the balance sheet, and the cash flow statement, the first 4 tabs there, I'm going to need that data. I'm going to put that in color. The WAC and the DCF tabs, I built those from scratch. I added a couple of sheets into the workbook, so those are built from scratch. It's not Capital IQ data for the most part. And then I've got like 10 different tabs here that I'm not going to use in any sort of way. And if I was turning this in, I would delete all those tabs. I've only got it there in black so you know that they exist. But they're garbage for purposes of putting this in the report because I'm not going to use anything there. So submitting a bunch of stuff here which I have nothing to say about is just clutter, so in practice, I wouldn't include that. Most of what you see here is black on white. Yep, it's what they gave me. There's some stuff like there's black on what's at the top there. Those things are in beige or tan or taupe or something like that. And I did orange for some things because I put these in orange background because I want to talk about them a little bit, but I didn't do anything with them. I just highlighted them. On the other hand, over here, you see stuff with a pink background, or sometimes I used light green or light blue or light yellow or colors that aren't orange. That's all me. I added it completely. So I had Look, there's a blank row here. I'm going to add some stuff. That's that pink stuff and multicolored stuff. That's me. That's not part of Capital IQ. That's orange. I just highlighted that cell. The orange, just highlighted those cells. Pink, that's me. Pink, blue, green, that's all me. There's nothing orange here. The WAC and the DCF, I drilled from scratch. All right. That's about as big as I want to make it. People see that okay? Nobody needs to come sit in the front row or anything? This is the key stats. This is a quick overview of some stuff. Got total revenue over the last 10 years. Somebody's expectations for revenue in the next couple of years, because this is 2026E, 2027E, 2028E. Those are estimates. September, September, September. This 12 months, September 30th, 2025, A is for actual, and that's the 12 months ending September 30th, 2025. That's Visa's fiscal year. It runs October 1 to September 30th. Okay? A lot of fiscal years match calendar years. Visa's doesn't for whatever reason. All right. I'm going to go to the income statement. What did I find in the income statement? Well, I found revenue, and I sometimes found other revenue, which was negative for whatever reason. I took the total revenue, which most years is the same as just the revenue. After 2016, they dropped the other revenue. And I calculated the revenue change. That's the this year's revenue minus the previous year's revenue divided by the previous year's revenue. Again, that's 2016 revenue minus 2015 revenue, that's the change, divided by 2015 revenues, that's the percentage change. So I'm calculating numbers 8.7, 21.7, 12.3, and so forth. 8.7, 21.7, 12.3. I go back to the key stats, 8.7, 21.7, 12.3. The growth over the prior year, I know exactly how that works. It matches what I just calculated. So they've calculated that as well. When I look at these numbers, what am I seeing? What would you read to you? I told you what Visa does. It takes a slice of everything in people in the United States body. That's a simplification, but that's the gist of it. The growth rates are 9%, 22%, 12, 12, minus 5, 10, 22, 11, 10, 11. Most of those are like 10, 11, 12% for the last decade. Except, I emphasize, it's a 22% in 2017. What? More to explain on that one. That's why I highlighted it in green. That's got a question mark in my mind. There's minus 5% in 2020. I thought about it. I'm pretty sure I can tell you why it's minus 5%. This is 12 months ending September 30th, 2020. I remind you what the last 6 months of this period looked like in the United States. And I'm going to simplify, as I will, for explanatory sake. It was COVID. Nobody could go to the store and buy anything, so we didn't. So yeah, Visa had less revenues because, COVID. That seems pretty obviously what was happening. I mean, there were some months where a lot of stores had to be closed, you might recall. So they weren't selling stuff. I think that explains the minus 5. There's a 21.6 here. I mean, a couple of things that might be happening on that 21.6. Maybe that's when we bounced back from COVID and everybody said, I'm going to start buying everything again, like good Americans. You'd expect some bounce back from COVID to make up for that minus 5% because eventually we started buying stuff again. So it might be part of that. It might be something else too. Later on, I'm going to come to the conclusion that this 21.7, that's just too weird for reasons I don't want to get into yet, so I'm not going there. I tried to wrap my head around here. I calculated the 5-year average, previous 5 years. That was 12.9%. 10-year average, previous 10 years, that's 11.4%. And then I included everything in the last Well, 10 out of 11 years, everything except for that green, which I'm suspicious of, and I'll tell you why later. And that worked out to be, what did it work out to be? 10.2%. And if I look across there, ignoring the green and the couple blues, Visa's grown by like 10% every year for the last decade. More or less, 11%, 9.5%, whatever. 10.2. I'm thinking that its growth rate will slow down a little bit, and I'm going to guess it's going to grow at 9.5% for the next decade. 9.5% top line growth rate for the next decade. I've got that bright yellow over there for the assumption, 9.5%, and I've thought out loud and told you why I thought that. I would appreciate that Antonio might not think that. He said, yeah, I would have picked like 8.5% for the next decade. And Faith would have said, well, I think they'll still grow at 10% for the next decade. That's fine. Fine. They would look at my analysis and say, I would change that yellow number to something else. That's why it's in bright yellow. You can see my assumption. You can argue about it, disagree with it. You're welcome to. But I've told you my thought process as I built my analysis. Yes? Below the revenue line 8 right there, the ones that are in boldface, they've got cost of goods sold. There's not much cost of goods sold because Visa's not really selling goods exactly. They're running the card machines and the electronic network. There's gross profit, there's selling general administrative, there's R&D expenses. No, they're not. It's zero across the board. There's depreciation amortization, and there's other operating expenses. Once. I did some calculations here. This revenue, 13,880 minus the cost of goods sold of 474 equals 13,406, the gross profit. Got it. Revenue minus COGS equals gross profit. You can check that for a few years. It's always true. Here's the most recent. 40,000 minus 894 is 39,106. And by the way, when it says 40,000, that's in millions. That's $40 billion. SG&A. SG&A and depreciation. And in some cases, in one case, the other operating income. If you put those together, that gives you this other operating expenses total here. In other words, this other operating expenses total is a subtotal of those 4 lines, though R&D is 0 across the board. So really it's a subtotal of 3 lines, and really other operating expense only shows up once, so it's almost a subtotal of those 2 lines. If you take the gross profit minus the other operating expenses, that gets you the operating income. Below operating income, let me know if there's nothing to do with depreciation and amortization. There's interest expense, there's other non-operating income, restructuring charges, impairment of goodwill, income tax expense, blah, 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 blah. Nothing to do with depreciation. No, this is the only place I can find depreciation. And I told you, I did subtotals. 3834 plus 494 equals 4328. The depreciation is separate from the SG&A, and it's separate from the cost of goods sold. If I take the cost of goods sold and the SG&A and the depreciation, that gives me the gap between the total revenue and the operating income. And there's nothing below the other operating income, so I pretty much know how depreciation works. It's got nothing to do with SG&A, it's got nothing to do with COGS, and that's why I'm comfortable calculating cash expenses. It's the COGS, it's the SG&A, that's it. Those are not tainted by depreciation, that's clearly a separate line, different number, no overlap there. Cost of goods sold and SG&A are the 2 flavors of cash expenses with 1 caveat. And I divided that by the same year's total revenue. That gave me the cash expenses as a fraction of revenue. Here's the caveat. There's a tiny one-time number under other operating expenses. I'm ignoring that because when I project into the future, I figure that's not going to happen again. I don't care. These numbers are interesting because I think they have something to do with the projections into the future. If you look at the cash expenses to revenue across the board here, here's the numbers. 31, 30, 30, 31, 30, 32, 31, 30, 30, 30, 30. That sounds like a whole lot of 30 with a tiny bit of variation. And it hasn't changed. It hasn't gotten more profitable. It hasn't gotten less profitable. It's been 30% across the board. And the 5-year average is 30.1%. The 10-year average is 30.3%. And I think you can see why I'm going to assume 30% going forward. By the way, those cash expenses are basically 30%. If you look at the key stats in orange here, the EBITDA margin, that's basically 70%. Yeah, because it's the same thing as revenues minus the cash expenses divided by the revenues. Revenues minus the 30% cash expenses and 70% revenues divided by revenue, yeah. It's not quite true for the first couple of years here. The first couple of years, that's not quite true because they're distinguishing between what they call the revenue and the total revenue. But going forward, there's not going to be any other revenue, I don't think. So I understand what's on the EBITDA margin. It's just factoring out the cash expenses. Let me talk a little bit about that depreciation and amortization. I told you that's clearly separate from the other stuff, and that's the depreciation. If we look at those numbers, 494, 502, 556, and so forth, and I pop over to the cash flow statement. This is the top of the cash flow statement. There's net income. There's depreciation and amortization, and there's amortization of goodwill and intangibles. But down here, there's other amortization. If I put all this together, 180 and 63, which is this subtotal, plus the 251, that gives me the 494. So line 7 and 8 and 12 together, that's 494, 502, 556, etc. 494, 502, 556, etc. So the depreciation and amortization is broken down into 3 flavors when I go over the cash flow statement. Line 7, depreciation and amortization. Line 8, amortization, goodwill, and intangibles. Line 12, other amortization. And that's it. I've looked up and I looked down. I don't see any more depreciation. I don't see any amortization. That seems to be all of it. So the stuff I saw, the income statement is depreciation. Comes in 3 flavors in the cash flow statement. That seems to be all of it. I'm pretty sure I have my head around depreciation. It goes up over time. 500, 600, 700, now up to 1,200. But you know what? So do the revenues. I calculated depreciation and amortization relative to the revenue. That's not the net income, by the way. It's the total revenue over here on the income statement. And here's the depreciation and amortization to revenue. 3.6, 3.3, 3.0, 3.0, 2.9, 3.5, 3.3, 2.9, 2.9, 2.9, 3.1. That's right around 3. They're pretty stable. No obvious trend worth a lick over time. The 5-year average, 3.0. The 10-year average, 3.1. My assumption, 3.0. Now this is not a challenge that I'm about to make. It's a thought experiment. Does anybody want to argue with me about the depreciation and amortization going forward? If you did, what would you argue? It should be 3.1. It should be 2.9% of revenues instead of 3.0. I can't imagine anybody doing anything more than this niggling difference. This seems pretty damn cold. It's right around 3% plus or minus rounding error. I'm feeling pretty sure on this one. Yeah? You see where I'm coming from. But because of that thought experiment, I'm feeling pretty good about, yeah, right around 3% of revenue. That's what depreciation should look like going forward. And by the way, if I hadn't mentioned it, I've got that depreciation to revenue assumption 3.0 bright yellow so I don't forget it. All right, so I mostly explained why I'm assuming that revenue growth is going for 9.5%. It's pretty large growth. It's certainly more than inflation. It's certainly more than growth in the U.S. GDP. But it's been growing like that for 10%, and there's reasons to think people are going to still move towards buying and selling on the internet, where it's harder to pay cash and it's easier to use a Visa card. So I'm thinking that growth will happen, that above average growth could happen for a long time, like 10 years. All right, what do we have besides the revenue change and the cash expenses to revenue on the income statement? We've got the earnings before taxes excluding and also including unusual items. Oh, before I go there, that depreciation, right around 3% of revenue. If you go to the key stats and instead of thinking about the EBITDA, you go to the EBIT margin, instead of 70%, you'll see numbers that are like 67%. What's that 3% difference? The DAW, in a margin sense, depreciation and amortization relative to revenue, the 3% that we just worked out. Yep, that's what they've got sitting over here on the key stats page. So I understand the EBITDA margin, it's revenues minus cash expenses over revenues. And I understand the EBIT margin. It's revenues minus cash expenses minus depreciation amortization over revenues. All right. Now we go to the taxes. We've got the income tax expense sitting here. So I'm able to calculate the income tax expense divided by the EBT, including unusual items. And I also can calculate it versus EBT excluding unusual items. If they're significantly different, well, that would be because I've got some big unusual items. Usually, if I can say that about unusual items, the usual unusual items show up as tax deductible, but not always. I've got this in pink except for 2017. That's in gray, because that's the weird tax year transition. The tax law changes in the United States in 27 is weird across the board. Not even in there. To the left here, this is the old tax regime of 35% federal, and over here, this is the new tax regime of 21% federal statutory corporate income tax rate. I've calculated the 5-year average, and I'm not going to calculate the 10-year average because I'm not going to use that weird 2017 year. I'm not going to use the previous years either. I calculated the 8-year average, all of the available years post new tax law. So the 8-year average, 19.1%. If I include the unusual items, if I exclude, it's a little different, 18.7%. There's the 5-year averages, a little bit lower. I'm going to assume 19% going forward. I'm not going to quibble too much about the third digit there, but 19, yeah, call it 19. That seems reasonable. One could imagine going a little bit lower to 18 and a fraction, I suppose, but I'm good with 19. Down here further, I've got the effective tax rate, 29.6, 25.2, 42.7. 29.6, 25.2, 42.7. That's clearly the taxes divided by the EBT, including unusual items. Excuse me. So I know how that one works, and I'm pretty much using the effective tax rate that they're listing as effective tax rate in percent. That's what I'm essentially using as my projections going forward. Let me look at the minority interest for just a moment, because it won't take more than a moment. Over the last 10 years, the minority interest in earnings has been 0 every year. In other words, as you go from the net income to the company, and you say, well, you know, part of that isn't related to the company. Somebody owns a small chunk here and there, that's not really the regular shareholders, and it goes to somebody else. The gap between the net income to the company and the net income. There's a gap there. How big is the gap at Visa? 0. Every year, last 10 years, 0. Doesn't look to me like there's any minority interest. That minority interest in earnings, if it was like 197 or 200 or 172 in the last few years, it's like, oh, 1% of the earnings goes as a minority interest. Or in the early years, it was 63 and 60 and 67. Again, you say, it looks like 1% of the earnings are going towards minority interest. But here, it's 0% of the earnings are going into minority interest as much as I can see. So I'm going with 0% minority interest. There seems to be nothing happening there. 0% going forward seems a safe bet. Down here to per share, line 56 is the weighted average basic shares outstanding. Well, that's fair enough, but it's not always easy to calculate the shares. Because sometimes you have things like quasi-shares or pseudo-shares. Employee stock options. Maybe it's in the money, maybe it's not, but we know how options work. Stock options are a leveraged position in the underlying stock. That's like a fraction of a share with some leverage overlaying it. So essentially, those are like having fractional shares floating around. So if we look at the dilution from stuff like that, well, as of the most recent numbers, weighted average basic, 1940. Weighted average diluted, 1966. What's the gap between 1966 and 1940? I took the ratio right here. 1966 divided by 1940, about 1.01, 1.013. If you want to account for the dilution for stuff like stock options, better tack on about 1.3% onto the number of shares outstanding. Did I mention that this spreadsheet workbook, although it's not available on Canvas, will be by the end of the week? Did I mention that? No, I'm mentioning it now. That when we work stuff out in class, it gets posted as a rule of thumb. So this stuff will be posted, but I didn't post it ahead of time. All right. Let me just remind you what we've done here. I looked at the change in revenue. 2017, something's weird there. That's why it's highlighted in green, 21.7%. I got a couple of years where things are weird. I got that in light blue. Light blue meaning it's weird, but not that weird. I think I can explain it. Again, the 2020, the minus 5% is COVID. 2022, I'm guessing partly at least, it's a bounce back from COVID. You know, if you're going to include COVID data, you want the bounce back from COVID. If you want the bounce back from COVID, you better include the COVID. Because if unusual things like that happen, usually they start and then they end. And you have to include both of those effects. They start and then they end. All right. Again, for some reasons I haven't explained yet, I'm going to ignore the 2017 revenue change. I'm going to strip that out. And I've taken those average numbers. Average over the last 10, 11 years, excluding that green, was 10.2. But going forward, I don't think it's going to grow quite that quick. So I'm assuming 9.5% revenue growth for the next decade. I've talked about the cash expenses to revenue. I know the cash expenses have stripped out depreciation. That's 30%. The tax rate going forward, 19%. Minority interest, there isn't any. And there's a little bit of dilution. Also, as we've seen on the cash flow statement that we're not done there, depreciation is about 3%. We're expecting to be 3% of revenue going forward. I want to go to the balance sheet. See what I can see there. First thing I can see there in bright orange, how much cash do they have? Well, cash and short-term investments, I'm lumping them in. You want to put a cash in quotation marks? Call it cash in quotation marks, because I'm not going to write out total cash as short-term investments every time. $19 billion. Most recent data, as of September 30th, 2025, that's what we got. As of December 31st, 2025, somebody knows, but it hasn't been published yet, so only the accountants know that number, so that's the freshest number we've got right now. Unless you know something else has been going on in Visa in the last few months. That's my best guess as to how much cash we have right now. The cash that was reported most recently. Yeah, there's total cash, and there's total current assets. All right. There's total current liabilities, and there's some stuff here that is not going to be part of working capital when I calculate it. Do we have any short-term borrowings here? No. So I'll assume that's zero. If it's been 0, 10, 11 years in a row, I reckon it's zero going forward. Current portion of long-term debt? Sometimes. Current portion of leases? Small, but sometimes, at least relatively recently, it's been happening. Fine. Here's the adjusted working capital divided by revenue. Roughly current assets minus current liabilities divided by revenue. But it's that current assets stripping out the total cash. So instead of 10 billion, we got 10 billion minus 6 billion is 4 billion. And current liabilities less the current portions of long-term debt and leases. Well, that year there wasn't any action there, but so that's 5 billion. So what did I say? 4 billion minus 5 billion, so that's minus 1 billion. And then I divide it by the revenue, which is not sitting here, it's sitting over on the income statement, so the revenue for the matching year. All right, I calculated for the last decade, and you can see what we've got. Minus 10, minus 18, minus 14, minus 23, minus 20, minus 17, minus 23, minus 23, minus 29, minus 21, minus 26. It's gotten better over time. In the sense that when you have working capital, that's your money that's being tied up temporarily. But when you have negative working capital, you're able to work with other people's money. Nice. And even relative to the size of the firm, or the size of the revenue, strictly speaking, that's gotten more and more negative over time over the last 10 years. So they're using more and more of other people's money. Good for them. So it looks like it's improved, though in the last few years, what are we looking at? Minus 23, minus 23, minus 29, minus 21. Minus what did I say? Minus 21, minus 26. The last 10-year average is minus 21.5. The 5-year average minus 24.6. The last 3 years minus 25.6. Most recent minus 26.4. I'm calling it minus 25% going forward. There's my guess. I told you the pieces of my thought process there. So there's an assumption. Over here in mostly orange, I've got the deferred tax liability, and we'll talk about that in just a minute or two or three. Mr. Jane.
Yeah. So I just wanted, for example, for the next assignment, we have to make an ECF valuation. So can we take an average of 5 years? That would be an exact way, like how you have taken, or should?
Sorry, an average of what are you looking at? Adjusted working capital?
Yeah, like for the last 5 years. Or
okay. So what I'm seeing here looks to me like a trend, based on the last 11 years, the stuff you see there in pink. By and large, it's improved. You know, early on here, we're looking at something negative low teens, and now we're looking at something I'm going to call negative mid-20s. Okay, so that's, the trend is improved. Has it gone down like that? No, it's gone down, but it sure looks like a trend to me. Do I think the trend is going to reverse? I have no particular reason to think so.
So can we take
So I'm putting more weight on the more recent numbers. And if you'll notice what I did, I said, well, again, the last 10 years, but I'm gonna put more weight on the last 5 years because I'm focusing on the more recent numbers, by definition. In fact, with the last 3 years and the last 1 year, thinking that maybe there's some trending more weight, I'll put in the most recent numbers. And by doing that, I'm thinking like 25%. If you like, it's a mixture of the 1 year, the 3 year, the 5 year, and the 10-year weighted average with.
Should we keep it fluctuating or should we do a straight line rate?
There's no point in modeling the fluctuation. What do you know about the fluctuations?
Assuming
You know they will be there.
yeah,
All right, for any given year, do you know if it's going to be up or down?
it's still a projection.
It's not a useful prediction. Your best guess is presumably, my guess is, minus 25-ish. If you read that as well, minus 23-ish. Okay, fine, minus 23, minus 23, minus 23. Just talk about, it's going to go minus 23 and then minus 27, then minus 23 and minus 27, minus 23. Why would you think that? If you were looking quarter by quarter or month by month over a retailer in the United States and you say, and then October, November, December happens and most of the country's thinking about Christmas presents, they spend a lot. I got it, I understand that seasonality. But why would you expect seasonality variation with a frequency, wavelength measured in years for adjusting working capital? And I don't see a story, I can't imagine a story where that would make sense. Can't think of one at all. So no, I wouldn't do that at all.
Given the inflation point of view for visas,
Given inflation,
yeah, for example,
and,
we have to correlate, that's a different case.
but I don't think of inflation as going like that. If I think inflation is like this and I have reason to think it's going to go up, I'm going to model it like that over time, or like that over time. And if I think it's going to go down, I'm going to model it kind of like that over time. I'm not going to. Why do I think I know stuff about sort of the second moment as opposed to the first moment? If you want to put it in a trend, that's different. But a sinusoidal curve, what data do I have about that? Any given moment, why do I think I know whether I'm on the up or the down part of the curve? If you don't have that, this part or that part, if you don't know, then there's no point in trying to model a sine curve. No value. Separately, it wouldn't, you'd be going to a lot of trouble and it wouldn't make much difference in the valuation. Especially with the working capital. Right, so a lot of hard work. We're good?
Yeah.
All right. I'm on line 43. It's in light orange there, the deferred tax liability, the non-current portion. We talked about this before. It's a bit of the flavor of accounts payable. It's a bit in the flavor of working capital. It's not literally working capital. It's not part of working capital, but it kind of has that flavor, similarity to it. And you look at the numbers over time. Here's what we got: 32, 48, 60, and then it drops. Well, yeah, because the way it's calculated is the effective tax rate times the gap between the cumulative depreciation for tax purposes and accounting purposes. And right around the gray, we know the tax rate went from like 35% to 21% more or less. Maybe slightly different for different companies, but the statutory rate dropped, so I would expect that to drop. Putting that aside, this seemed to have gone up, 32, 48 to 60, and then dropped probably due to the tax rate. 46, 48, 52, 61, 53, 51, 53, 55. How do you read that? I read that as either A, drifting up over time. Is it in proportion to the revenue? I don't know. I'm not going to go there this time. That's a little more complicated than I want to go for stock analysis number one. I'm going to go with B. Post 2017, so for the last 8 years, it's been about $5,500. That's $5.5 billion. And I'm gonna assume it's gonna stay about 5,500. And maybe this is a slightly simplistic assumption, but again, this is stock valuation number one, so I'm gonna give it a little bit of simplistic assumption, especially on what's potentially one of the trickier parts of this. So I'm gonna use at 5.5 billion, and I'm gonna assume it stays at 5.5 billion. I'll do something more complicated next time I value a stock. For this time, let's roll with that. So I'm just gonna fix that 5.5 billion. Anything down here? Oh, yes, there is. What we have here, as of September 30th, 2025, the most recent reporting date, and it's the end of that time period. We have the total shares outstanding on the filing date and the total shares outstanding on the balance date. The balance sheet date is September 30th. The filing date, a few weeks later, when the accountants filed the data with the Securities and Exchange Commission. I'll take the fresher things. So I'm going to take the 1914. Oh, wait, but that's actually basic. And I want the diluted. So I have to tack on 1.3% to that as per our previous calculation, the 1.3%. So times that extra 1.3%, times 1 plus 1.3%, as per our previous calculation, diluted versus basic. So I'm thinking right now, right around 1,940, which really reads 1.94 billion shares. All right, I see how much cash they've got right now. My projection of working capital. Just deferred tax liabilities. How many shares? And by the way, inside this, I calculated year by year what the adjusted working capital is. I'll use that later. Cash flow. On the cash flow statement, I've talked about depreciation and amortization. That's going to be 3% of revenue. And I've got capital expenditure. Every year? Every year. And sale of property, plant, and equipment. Anti-capital expenditure, the opposite of capital expenditure. I'll be netting that out. Net that out. And I see cash acquisitions. Well, 9 years out of 10, or maybe it's 10 years out of 11 acquisitions. And divestitures. Nope, but if they were there, I'd call it anti-cash acquisitions, and I net those two out as well. Here's what I want. Capital expenditures and cash acquisitions combined, and I'm going to net out any sale of property, plant, and equipment, and any divestitures, anti-capital expenditures, and cash acquisitions. I have no particular reason to think they've done any acquisitions which aren't cash-based. One way to find out is looking at the number of shares outstanding, and has it changed significantly over time. So I'm not going to call it capital expenditures plus cash acquisitions, netted out with their opposites. No, I'm just going to call it CapEx in quotes. Is that a correct accounting term? No. Is that me looking for a good shorthand? Absolutely. The only other good shorthand I can think is just call it CX in quotes. That would be even shorter. But again, that's my notation. That quotation mark, obviously, it's not literally CapEx. It's got this other stuff thrown in it, da, 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 da. Taking the sum of all four of those. Granted, nothing happened in the divestitures, and not much in the sale of property, plant, and equipment, but I'm still taking the sum of all those. Dividing it by the corresponding revenue, that's over from the income statement. I'm putting a minus sign in front of this because it annoys me when I put the capital expenditure as a negative number, like I'm too stupid to know an expenditure number is spending money. So quote, CapEx. Money we're spending on growth, 3.6% of revenue. 3.6, and then in pink, 5.4, 4.4, 6.3, 3.7, 3.2, 10.0, 3.2, 6.0, 5.9. What is that, 3, 4, 5, 6%-ish? The other one's a little bigger. Yeah, 5.7%, that's for the last, I didn't label this, I did up there. That's the 5-year average. That's the 10-year average. 63.7%. That sure looks like an outlier. Yeah, $9 billion. That's far more than any other year. $9 billion. September 2016. Huh. And the next year they grew 22%. That's because they did a big acquisition then. And yeah, of course they grew. Last year you could have looked into Capital IQ and downloaded the M&A and got an idea of what it was. This year it's not there because it's been too long, 1 year too long. They bought something called Visa Europe, which is pretty much exactly what you think it was. And in some years before, for some reason, they had split off Visa Europe, and now we're bringing it back under our umbrella. So they spent significantly, and now when you use your Visa card in Europe, it goes to the Visa company and not to the Visa Europe company. Yeah, so okay, that's why that whopping big acquisition there clearly corresponds to that 21.7% revenue change. I'm stripping that revenue change out. Don't reckon that's going to be happening again. I don't think there's any Visa Asia out there for them to bring back under the umbrella. You know, and South America and Africa won't do it. So again, this green is being stripped out of the revenue. I'm not counting it. Whereas these blue ones, I am including those. If I do look at these numbers, I might also note the second biggest number is another acquisition right there, column I. That 21.6% showing up in column I. Part of that is probably this acquisition here. My judgment is going to be, look, that blue one, I'll take that. That's within the realm of reasonableness. That's a modest size acquisition. The green one, that's just unusually big. I'm stripping that out. Notice I'm stripping out the benefits and the cost. I'm stripping out the green, whatever it is, column C acquisition. I'm stripping out the benefits of revenue growth. I'm not including that in my projections of revenue going forward. And I'm also stripping out the cost. I'm not going to count that 63.7 as part of my averages projecting the cost of CapEx and M&A going forward. The blue one, I am including that both in the growth and revenue. I've already done that. But I'm also going to include that 10%. Yep, that's a usual as opposed to a green, unusual sort of cost of M&A CapEx going forward. So it's 11.2%, and no, that's not good. If I want to take, let's say, I think that's 10 years there. That's 10 years there, the last 11 years, but not counting the green one. That averages out to 5.2. The low end is 3.2, the high end is 10.0, so we have some variation there, true. The average is 5.2. Last 5-year average is 5.7. It's not obvious that there's a particular trend here. I'm going to assume their cost of CapEx and M&A over the last 10 years as a fraction of the revenue of the firm. I'm just rolling with that 5.2 going forward. I don't see a particular trend or reason to think otherwise. If you thought maybe it should be 5.7, well, I could see that. But I'm going with 5.2. I've told you my thoughts. Let me kind of summarize this. Over on the discounted cash flow statement, I've made a whole list of assumptions. The revenue growth is 9.5%. That's from the income statement. And you can see there's some variation, 8.7, 12.3, 11.5, the 21.6, the minus 4.9. I could see going with a little bit higher or a little bit lower, so I will do a sensitivity analysis with respect to that 9.5%, but there's that assumption. The cash expenses to revenue, I told you I'm pretty sure about that 30%. There's that assumption. It's kind of silly to do a sensitivity analysis there, but I'm going to change 4 variables. So I'm thinking of doing a lot more sensitivity analysis on the cash expenses than I need to. If instead of calling it cash expenses, you can call it expenses, but not including the depreciation. That would be equivalent. The depreciation to revenues, we saw that in the cash flow, that 3.0 right there. The so-called CapEx to revenues, 5.2%. We just talked about that moments ago. See, what are the assumptions? There's the tax rate, 19%. Check. Minority interest, well, it's not a very interesting assumption here, but it is right there. And under the balance sheet, there we've got the adjusted working capital revenue, minus 25% for that fraction. There is an assumption about deferred tax liability. I'm going to assume it's constant, not growing. So it's not going to generate a cash flow per se. There's $19 billion, the freshest number we have for cash. So I'm assuming that. Under the balance sheet, we estimated 1939. There's the number of shares outstanding. Check. We're going to make projections into the future. And I'm going to start with the last 12 months. And the last 12 months, the revenue's been $40 billion. Looks like even. I suppose it could have been just that. All right, 40 billion then. That's for 2025. That's technically what I mean there is the 12 months ending September 30th of 2025, the most recent data we have. The adjusted working capital for 2025. The most recent number we have for the adjusted working capital, it's minus 26.4% of revenue. And that revenue was the 40 billion we mentioned. So the minus 26.4% of revenue. That's not all my assumptions, but I just highlighted over there stuff that I've already assumed, or I'll tell you where I'm going from. I'm going to start projecting into the future in just a moment, and it's going to start with the most recent past, where we made revenue of $40 billion, probably a little more next year, and a little more the year after that, about 10% more, 9.5% more, is what I assume, going out 10 years into the future. So with respect to the stuff that's been highlighted in gray, any questions? Because I need to go in a different direction before I come back here and do these calculations. Ansh.
So for the shares adjusted, is that the diluted shares?
It is the diluted. It is. We said better add 1.3%. So we took the most recent quote of how many shares outstanding, tacked on 1.3% on top of that. You can find it in pink right there. This was 1914 was the most recent total shares outstanding on filing date, and it's multiplied by 1 plus 1.3% as per the calculation from the dilution of the income statement. So that's where the fresh number is coming from. Fresh as we got, but yeah. Anything else? Yes, Scott.
I have a question about
Please.
Something else. Why don't they have anything that they're
like, I'm assuming they would have something about like the payment technologies, are that incorporated somewhere else?
The correct answer is I don't know. That's literally true. Would you like me to guess?
Yeah.
Okay, I'm gonna guess that it's showing up. Either under COGS or SG&A. Would you like me to guess why?
Yeah, because
It's not like it's pharmaceuticals where you literally do an R&D and you're in the laboratory, the chemistry, the biochemistry laboratory and messing around trying to figure out how to make a drug.
so it's not a
Right.
big portion.
You're just like rewriting the software or figuring out if we can, write a little bit more efficiently or something like that, or making adjustments to that. And maybe the accountants, the rules of accounting say, that's not a big number. You can slide it under COGS or SG&A. That's my guess.
Sure.
Okay. Other questions? All right. Right. This I can pop up. All the calculations are made as of January 19th. Over the weekend, took the freshest data available over the weekend. This is Friday, 4 p.m. New York close data. Going to calculate the WAC. First of all, on the RE side, the beta 1.025. Normally, I would just take it to 2 digits past this, but I took a January 1 to January 1, ending January 1, 2026. That's the standard way we're going to do it, January 1 to January 21, to January 1, ending 2026. Looked it up on Bloomberg. Normally gives me 2 digits past the decimal. This one was 1.025, and rather than round it to 1.02 or 1.03, here I'll keep the 3rd digit. So there's the beta, as per Bloomberg, last full 10 years. Regression against the S&P 500, daily data. The volatility, by the way, is 24.5%. To put it in perspective, the entire S&P 500 is 18% over the same time period. For the risk-free rate, I looked at the 30-year Treasury bond yield. Went to treasury.gov. That unsmiling man is the current Treasury Secretary. Went to get the interest rates. Told you I did it over the weekend. Over the weekend, the data for the 20th and the 21st were not available. 4.83 is the 30-year rate. 4.83%, 4.83%. There we go. 4.83% for my risk-free rate plus a beta of 1.025. I told you why I took the 3rd digit past the decimal. And times the 6%. RE 10.98%. Got it. Rather than talk about RD, I'm going to skip that just for a moment. I'm going to pop over to Yahoo Finance. Got it. I get out of the way. Visa, there's the current stock price, 326 change. The market cap, 630.8. 630.8. There's a beta. It's rubbish. It's 0.81. That's not even close. The beta is right around 1, and it has been when I ran this last year and the year before. Antonio, please.
Yeah, what is the 30-year Treasury note?
That's the long term. In US dollars, it's the longest term riskless interest rate we get.
Yeah.
And how long do I expect Visa to last? A long time.
Yeah, okay, yeah, it was just for comparing.
Some people like to use 10 years. I like to use 30 years. And the 6% I used for the market risk premium was calculated and estimated. The 6% that we used up there, that 6% there, against long-term bonds. I appreciate in some other countries they don't have 30-year bonds. In some other countries, Canada has 40-year bonds. The UK and Australia, at least one of them has more than 30-year bonds. They might even have 50-year bonds. But in some countries, is like, I think Brazil only has 10-year bonds. So there's some variability. We agreed last time. 30 years is what we'll use here by executive decision, because we're going to be consistent across all three sections of practice. So 30-year government bonds, 6% beta against the S&P 500 index for the last 10 years, January 1 to January 1 on Bloomberg. Okay? All right, so market cap 630.8. It was slightly different when I looked it up over the weekend. It was 634. The debt, I'm going to statistics here. Statistics. Down to the bottom here, the balance sheet. Total debt, 26.1 billion. Total cash, 19 billion. 19 billion? Really? Yeah. Yeah, they're getting for the same sorts we did. There's the 19 billion in cash. Anyhow, 26.1 billion in debt minus the 19 billion in cash. Net, call it 7.1 billion in net debt. There we go. That's like 1% of the equity. Equity ratio, debt ratio, 1% debt, 99% equity. Went to Cap IQ, which is annoyingly locking me out right now, but I found five bonds that were long bonds. There are the maturity dates of them. I went to the fixed income. One of them had an interest rate that was much lower, and then I looked at it carefully, and it's like, it's denominated in euro, where interest rates are lower. I need US dollar bonds, so there were 4 of them. There were the yields, strictly speaking, it's yield to worse. That's what was posted. This bond here, the 2050 bond. Let's see, we're in early 2026. That's what, a 24.5-year bond? 24.5-year bond from now? Something like that. Twenty-year treasuries yielding 4.79, 30-year treasuries yielding 4.83, 24.5, 25-year treasuries yielding, split the difference, 4.81%. Just linearly interpolating, splitting the difference, 4.81%. 30-year treasury, 4.83%. Let me take this bond right here. December 2045, where are we? We're just past December 2025. So that's a 20-year bond within a month. 20-year bond yield at Treasuries, 4.79. Got it. 2040, that's a 14-year bond? Got a 14-year bond. 10-year yields, 20-year yields, you can interpolate. Call it a 13 1/3 year bond and say a third of the way from the 10-year to the 20-year is 79 minus 24, that's 55 basis points. A third of that is, what, 28 basis points? No. 18 basis points, something like that. And then you add to 4.24, you get a yield of 5%. Sorry, a yield of 4.46%. So you look at 30-year treasuries as opposed to the 25-year treasuries. The 30-year versus the 25-year treasuries are 2 basis points more. All right, I'll add 2 basis points to the 25-year Visa bond. Call it 5.38 if it was a 30-year bond. The 2045 here is a 20-year bond. If I compare 30-year treasuries to 20-year treasuries, the 30-year treasuries yield 4 basis points more. So if this 20-year bond was really a 30-year bond, it would probably yield 4 basis points more. Takes to 5.38. On this roughly 15-year bond, 14-year bond, whatever it is, it was yielding 4.46% for treasuries. 30-year treasuries are 4.83%. That's 37 basis points higher. So I figure if this 14-year bond was actually a 30-year bond, it'd be 37 basis points higher. That takes you to 5.37. So you'll note these do have somewhat different yields, but when you adjust them for the fact that they also have different maturities, and you adjust that, what does that average to? 5.38, 5.39%. That's pretty consistent across the 4 bonds. I feel pretty good about that number. RD is 5.39%. There's the WACC. I've got the RE, I've got the RD, I've got the equity, the debt, the tax rate 19%. We worked that out before. WACC 10.9%. There's that one. Amar.
So in the WACC formula, are we multiplying the tax rate with both the equity and debt section, or it's just the debt?
Equity ratio times RE plus debt ratio times RD times 1 minus tax rate. Standard WACC formula.
So just multiplying the debt section with the tax rate.
The only way the tax appears is 1 minus the tax rate times the RD times the debt ratio. Tax rate doesn't affect RE. See if this works. Does this work? No, not worth it. There's one place it shows up. Yeah, that's where I put it in. Yep. Anybody else? All right. Here's my projections. Most recent 12 months, revenue is 40 billion. Going forward, I'm thinking 9.5% a year more. Pop the font size. 9.5% a year more for the next 10 years. Done. Cash expenses, 30% of revenues. Great, because I just projected the revenues, I can work out 30%, that's pretty straightforward. Depreciation, 3% of revenues. Super, I've worked out the revenues the next 10 years, 3% is pretty straightforward. So-called CapEx, in the way that I defined it, I'm not going to go into that again. It was 5.2% of the revenues, the top line that we projected 4 lines ago, so pretty straightforward. The working capital is minus 25% of revenue. Minus 25%, minus 25%, minus 25%. Everything so far is being proportionate. Free cash flows. 5 flavors. Got revenue right up at the top there. That's flavor number 1. Minus cash expenses. Got it right next to revenues. Flavor number 2. Minus a CapEx. Yeah, it's actually CapEx plus M&A there in line 7 in green, but there we go. Subtracted that off. Flavor 4 is the corporate income tax calculation as if we have all equity financed. That's a cell C6. Done. I'll talk about that in a while. I gotta go back and talk about it, but I've got the taxes there. And then, that's the change in working capital with the appropriate sign. Subtract off today's working capital, but give yourself credit for the working capital already in place. So that's the change in working capital with the appropriate sign. Here's the tax. Tax rate of 19% times revenue minus cash expenses minus depreciation. Carried across the board. There's the next 10 years I'm projecting a free cash flow. The rest of it, I'm making a guess as to the permanent growth rate. I don't have much time, but here's the argument. What is Visa doing? It's taking a slice of the U.S. economy. I told you this up front. How do I expect the U.S. economy to grow? Based on treasuries and tips most recently, projected long-term, like 10, 20, 30-year inflation rates, 2.3%. 2.3%. Real growth. If you look at real growth in the GDP since 1960, it's averaged almost exactly 3%. But if you look over the last 20 years, it's almost exactly 2%. If you look over the last 10 years, it's been 2.5%. The economy is probably slowing because things, as they get bigger, tend to grow at a slower rate. So I'm tempted to use 2.5%. 2.5% plus 2.3% takes me to 4.8%. But if I look at what Visa is doing, as the world, as trade moves more and more to ordering stuff on the internet and electronic sorts of stuff, it's likely to be growing at a bigger rate than that for a long time, because people are moving away from cash and towards, you want to call it digital payments? Visa's digital payments. It's a judgment call. I'm tacking on 50 basis points of growth for that. Faith might have a different opinion. Jack might have a different opinion. Fine, I've told you my logic. That's what I'm using. What I'm going to do is I'm going to try to flash forward 10 years in the future. Try to value the firm 10 years in the future. What I'm looking at is cash flows of 53.7, but they're growing at 5.3% in perpetuity. All right. That means the 2036 next year's cash flow is 5.3% on top of the 53.7 billion. That's the numerator. And then I divide by R minus G, where R is the WACC, 10.9%. And G is the permanent growth rate, 5.3%. About $1 trillion for valuation in 2035. Now I'm looking at value as of today. In red, you see cash flows 1, 2, 3, 4, 5, 6, 7, 8, 9. Oh, in 2035 is year 10. So the purple one is year 10. And then on top of that, 2036 forward, I've now valued that as of $2035 of $1 trillion. Cell right above. I'm going to discount those all back, quote, to the present. Here's the problem. That 2026 column C, that runs September 30th, 2025 to September 30th, 2026. The midpoint is March 30th, a couple of months from now. When I discount it back 12 months, that takes me back to March 30th, 2025. I discounted it back too far. So again, if I treat those red numbers, 23,197, 26,014 as years 1, 2, 3, etc., I discount back too far in the past. I discount back to roughly, and I'm not going to sweat it, if I think of this as January 1st, I discounted back 9 months ago. So I have to move it forward 9 months, which is this. This is a good point to note that I subtract off 0% for no minority interest. That values the enterprise as of today. To get the equity, I have to add in the cash, that's 19 billion, and subtract off the so-called liabilities. What are they? Under the balance sheet, there's the total liabilities right there, about $62 billion. But, two things. One is that the stuff that's been sitting in working capital, the current liabilities less the current portion of long-term debt and the leases, don't double count that, subtract that out of the 62 billion. So it's the 62 billion less that's roughly 30 billion. 62 billion less the roughly 30 billion that's been part of working capital. And I argued the deferred tax liability, that can be bumped into the future, so it's a liability that never really comes due for Visa. I'm going to subtract off this 5 billion as well. That's what's in that calculation. So, adding the cash, subtracting off the liabilities that actually matter, and getting a share price by dividing through by the number of shares. That's the equity value, that's the price. The stock price over the weekend was $3.28, now it's $3.27. Okay, fine. I'm going to call that a tie. What sense? Well, I didn't expect it to be exactly the same as the stock price. The stock value and the stock price are similar. Usually if you're within 10%, Yeah, that's fair enough. It's near market, the fair value is near the same as the market price, that's close enough. If there's a 10% difference in one direction or the other, then you say,